Well, hello, everyone. Welcome back to another presentation by Chat with Traders Community. This is your host, Ian Cox. And today we have a guest here to share with us his background and share with us about being on the right side of the market. His name is Anmol Singh. Welcome, Anmol, to Chat with Traders Community.
Thanks for having me. Looking forward to chatting with you.
Yeah, sure. So tell us a little bit about your background, kind of where you grow up, where you are now.
Yeah, definitely. So I was born and raised in India, and then I moved to London to do my business degree when I was 18. And then in my dorm room is when I actually got the trading bug, got bit by the trading bug. We're watching a lot of movies, reading a lot of books on the topic. And that's where I really started to get really involved with the financial markets. And my curiosity kind of took over and wanting me to learn a lot more. So in the college, I started the Trading and Investing Society. I noticed that there's society for everything. If you play a sport, there's a club you can join. There's entrepreneur society, but there was nothing to do with trading and investing. So I started that, and it's great to know that that still exists till date in the same college. So that's where I originally got into trading, and then when it was my second year of college, I joined a prop firm in New York, trading remotely for them while I was still in my dorm room. I was trading their capital and splitting profits with them on a 70-30 basis. And I did that since pretty much college all the way till from 2010 till 2015. And then that firm got bought out in 2015. And then that's when I eventually kind of went off on my own and started to trade. So I've been doing that for 13 years now.
Oh, wow. So your first experience with trading the markets was through a prop firm prior to having your own individual account?
Yeah, so I had my individual account. So when I first started, I had like 10,000 that I started with. Pretty quickly, that went to zero because I didn't have any money left because I had no idea what I was doing. I thought, pushing the button makes you a trader. Clearly, lesson learned. I would say the easy way because at this stage, people could lose a lot more money. So, looking back, I was like, okay, it's a $10,000 lesson, not bad. And I was writing articles still in my dorm room to accumulate the capital as a freelancer. They would pay me $1,000 or $1,500, per article. So I wrote it back to get my capital base back to, that $10,000 level. And then I put up that capital with a prop firm as I guess a joining fee, so to speak, a risk capital. So I put that, traded with them, and then never looked back, just kept progressing through the firm. And I got to about level 7 where I was trading roughly $10 million of their capital.
Oh, wow. That's quite an accomplishment. What would you say some of the advantages and disadvantages are with trading with a prop firm?
So the advantages, there's a difference between prop firms now and back in the day. Back in the day, what I found is prop firms actually cared about their traders making money. They wanted to teach them, coach them. There was a good element of coaching and mentorship in there because the money in a prop firm, they would make in a profit split. So the traders make money, the firm makes more money. Nowadays, the model has changed a lot. Prop firms don't really coach or mentor traders. They're kind of glorified brokers now, right? They're making money on the fees. So if a trader keeps trading, they'll make money. They don't care if you win or lose. And that's why you'll see prop firms these days are offering 90-10 splits or 98-2 because they don't, really expect people to do much. They're just making fees as a broker. But the advantages, there's a lot of advantages. The advantages are forced risk management. Right. For me, risk management forced upon me. Hey, if you lose X amount, we're going to shut off your platform. You can't even trade anymore. Right. So that kept me disciplined. Whereas in individual traders, especially in the era of Reddit, GameStop, and AMC, they just blindly gamble and there's nobody to, follow up on their risk. They could do a lot of damage to themselves and their accounts. So with a prop firm, I could not have that because they would just shut off the account if I had a loss limit for the day, even for the loss limit for the week. And then it had a nice progression model. Hey, you're going to start on a demo. Okay, you hit your profit goal, we're going to give you 50,000 to trade. Okay, you hit your profits goal, we're going to give you 75. So it was like a stair step way up. So it wasn't like I made a big leap from $0 to $10 million. It was 0 to 50,000 to 75,000 to 100,000. And I think that made it maybe more disciplined as a trader. So that's the biggest pros.
And so why do you think that nowadays prop firms are not into educating their traders much like they were in the past? Is there a supply and demand imbalance for this to occur? Are there a lot more traders wanting to sign on with a prop firm, and so they don't feel they need to train them or mentor them like they did with you?
Correct. So, back in the day, prop firms would usually be started by people who were traders, just like, you and I. We're traders, we're making money now, we're coaching others, we're giving them our capital so our capital can go further. So that was the model. But then something changed over the last few years where there was a lot more people, as you said, coming into the markets. So the broker said, well, what if we just let everybody come in and trade for the prop firm and we'll just make a kickback on the commission? And especially when we went over to a free commission model, but prop firms still charge you fees. They make money on the platform fees. There's a lot of different avenues. So they probably changed their business model by looking at saying, hey, we have to spend so much time coaching and mentoring a trader. It might take 1 or 2 years before one trader becomes profitable in the firm. Now they have to do it with 50 other traders. So rather they just fill up the desk and make money on commission. So definitely the model changed a lot recently. There's still a few prop firms that still exist that have that old model of coaching and mentoring. But it's very few and far between. And a lot of prop firms these days are offshore, which is, it's a bit of a gray area.
Mm-hmm. What ways are there for people who do trade through a prop firm or even individual traders to become accountable to themselves? How did you do that journey? Did you have fellow traders that you shared what you're doing with?
Yeah, I think surrounding yourself with a community of traders is really important, right? And I think that's one of the things you do with your podcast is having the community that comes together and helps each other get better. That's extremely important. I couldn't have done it without my mentors. I couldn't have done it without the coaches that were with me, because there was a lot of times I thought about giving up in my first, second year. I kept missing my profit targets and I was like, well, is this my level? Is this how far I can get to? Maybe I should give up. And then there'll be other traders being, hey, let's be objective. Let's take a look at our spreadsheet. And then say, okay, what if you just scaled it like this? Then you could do this. And we helped each other get better. And I think that was probably the biggest difference maker in my trading, is surrounding myself with people who were on the same path as me. And usually they were better at me or better at trading than me, right? So they kind of pulled me up, and they could see the pitfalls of, hey, if you're winning too much, you'll get a message from my trading people. Hey, just let you know, don't get complacent. You've had a good streak. So we just keep each other accountable. I think this is really important.
Oh, great. And then, so did you get a chance to actually work any real job, or not real, but job out in the regular world after graduating from school, or did you just jump right into trading and that was your full-time job from day one?
Yeah, that's pretty much it. I haven't never had a job. I've basically been trading, got to my dorm room, started into trading, joined the prop firm, and then have been involved in trading ever since. So that's why I tell people I don't think I'm employable. So I have to be good at trading. I have no other choice because I have no experience. I have no work experience. I've been trading since, my dorm room days. I haven't done any other jobs or anything like that. So I have to be good at trading.
Yeah. So what year was that when you made your first trades? How far back are we going?
We're going to 2010 was the first trade that I put on.
Okay, 2010. So this is post great financial crisis, and you were learning. Just out of curiosity, since your presentation today is about being on the right side of the market, did you follow the markets prior to making your first trades? Were you in tune with what was going on prior to making your first trade?
Not at the time of taking the trade, but now obviously going back, I always take a look at what the markets did previously. I even go back as much as the 90s when I'm looking at correlations of the markets. And then I also take a look at Nikkei and other markets and try to figure out correlation. So I didn't do that then when I was brand new. But now, obviously, when we're making decisions with technology, it's so easy to go back in time and take a look how the chart played out then. But what we're going to talk about today on being on the right side of the markets is universal. It applies to all market conditions. It applies to every financial instrument. And we'll go over some examples later showing the different stocks and different patterns that have the exact same pattern that we're going to show on the slideshows.
Great. Also, if anyone has any questions, please ask them. You can type in the chat box if you have any questions right now. Please speak them.
Don't be shy. I'm not going to bite. Feel free to ask questions.
Well, great. Why don't we jump into your presentation today about being on the right side of the markets, and what does that really mean? I mean, just isn't that kind of natural? Don't everybody? That's a kind of a natural thing to think about, being on the right side of a trending market, but there's more to it.
Yeah, I think there's definitely more to it. We're going to talk about the 4 market stages. And being on the right side. Everybody wants to be on the right side, and everybody actually thinks they're on the right side when we're putting on the trade. But it's important to kind of step back and take a look at where we are in the overall cycle. There's only 4 market stages, right? Markets can only do 3 things. They could either go up, down, or sideways. So once you just learn to read which method or which stage we're in, then the actual price that you enter a stock doesn't really matter. If you're in the right stage, you're going to get that move. So we're going to talk about that later today.
Okay.
We're going to talk about the 4 market stages. So there's stage 1, which is considered the accumulation phase. So we're going to talk about it in the charts when we take a look later. But just to briefly describe, there are 4 market stages. And then stage 1 is where markets are consolidating. Usually they're going sideways. Nobody really cares about the stock. People almost forgot about it. And it's completely going sideways. It's fairly uneventful emotion of apathy or indifference towards that financial instrument. So that's considered stage 1. And usually, but not always, they're going to have a narrow range. It's not going to be like a wide and whippy consolidation. It's going to be more so like a, narrow sideways type of consolidation. So that's typically considered stage 1. That's what we call the accumulation phase. That's where, the big funds or whatever you might want to call it, the overall market sentiment is off, accumulating that stock for a run up again. So now when a stock breaks out of a stage 1 trend, it enters known as stage 2, which is the demand trend. So this is when a stock is basically uptrending. It's in a demand phase. It's associated with a lot of buying from greedy traders and investors. And stage 2 is usually wide range move with increased volume and lots of activity. This is a stage where many people make money and greed is dominant. After a period of uptrend of stage 2, we enter what is known as the distribution phase or stage 3. So this is associated with a lot of back and forth action, almost like a tug of war between buyers and sellers. And typically, but not always, it's going to be very wide and whippy. It's going to be a bit sloppy stage 3 because there's a lot of indecision being happening there. Then finally, the buyers give up, sellers take control, and then we enter what's known as a stage 4, which is a downtrending market or a supply market, which, as we said, is associated with a lot of fear, a lot of selling. And then usually as the stock starts to go down, the lower it goes, it gets accelerated. And then eventually that trend exhausts itself when we enter a period of sideways pattern again, back into a stage 1. So those are the 4 market stages that the markets move at. It'll make a lot more sense when we go over the next slide over here. So this is how, in an illustration form, it would look. Stage 1 will be when a stock is completely going sideways. Typically in that area, you're going to notice, let's say a moving average is like a 21 period moving average is going to be going sideways at that moment. After a sideways base, you get that breakout. Then you enter a stage 2 uptrend, right? After a stage 2 uptrend, we start to get, again, wide and whippy. Now this wide and whippy, because it's coming after an uptrend, that's how we know this is not a stage 1. That's how we know this is a stage 3, because it's coming after a stage 2. Then after a stage 3, this is typically where people talk about those traditional patterns like double tops, head and shoulders. That's where they usually happen, is about stage 3. And then when we finally break down, we enter a period of stage 4 declining downtrend. And moving averages are a good guide to figure out where we are in the stage, because as you will see over here, they'll be going sideways when we're in the stage 1. Then now the price is above the moving average in a stage 2. Then they'll start to go sideways again. And then once we break the price below the 21 MA, that's when we enter a stage 4 downtrend. So this is what it would look on a macro basis. Here's a few examples of different type of trades that could be done on it. And by the way, guys, I do talk a bit fast. So if there's any questions that come up along the way, feel free to just unmute yourselves and hop on, or just type it in the chat. I'd be happy to answer them for you. So this is the sort of patterns we trade in those trends. So now that we're in a stage 1, what we're going to do, usually what we do as traders, is we look to buy the breakout out of stage 1, because then we're going to enter a stage 2 uptrend, right? After it breaks out, again, another technical analysis concept is when something is into resistance, it breaks it on the way down, that same supply resistance area becomes support. So the next pullback back into a stage 1 is usually buyable. That's what I call a transition buy setup, because it's transitioning from stage 1 into stage 2. Typically in a stage 2, you're going to get a narrow consolidation. That's just a pause in the stage 2 uptrend, where we're going to get continuous breakouts, where we're going to break out again. And then the next pullback again is always buyable. And, I don't have a trend line on this chart, but if I was to draw a trend line, that's what the trend line traders are really doing, right? We're buying pullbacks into the trend line and we're buying breakouts into a stage 2 uptrend. That's all I do in a stage 2 uptrend is buy breakouts and buy pullbacks. We're not going to be buying here. We're not going to be buying here. We're going to be buying after consolidation or on a pullback. And then we entered the stage 3 again, right? Wide and whippy. And you can also see it broke the uptrend line as well. And then typically right there, you could either short it as a breakdown pattern, shorting it, or you could just wait. Now, same thing here. This area was support, became resistance, right? So then this is what we call a sell setup. You can short the retracement back into resistance and then follow the same concepts in reverse, where stock's now consolidating. Then we know because this is in a stage 4, it's likely not to do that, but it's likely to break down. But the key is we're not predicting. We're going to let it break down and then enter the trade. That's when we enter the stage 4 downtrend. And then the cycle repeats over and over and over again. And a lot of times, people say, but if the cycle repeats over and over again, that means the stock's never going to go anywhere, right? Because it's just going to hang around here. So the cycles will always happen. The thing is, this cycle could be shorter in a macro way, where this could be a bigger uptrend. The cycle will still happen, right? And then in a smaller time frame on a daily chart, you might see the same thing again, stage 1, back into a stage 2, and the cycle will resume yet again. So an example, I'm going to bring up some charts and I'm going to show you on a monthly time frame some of the most popular instruments from the last few years, stocks as well as cryptos. We can take a look that exhibit the same exact pattern. But these things also happen on a smaller time frame for day trading, for intraday swing trading. And here's how I would look for that. So this is a 60-minute chart, an hourly chart of a stock, right? Now we can see this was the stage 3. It was wide and whippy, finally broke down under the moving averages, right? That's when it starts to stage 4. Next retracement, as we talked about, right? Into that area can be shorted. You can even short a breakdown into a stage 4. We go lower, and then look what happens. We enter sideways again, start to go sideways again. That's a stage 1 accumulation base. Moving averages are flattening again. Price finally gets above the moving average. Now this breakout is viable, right? Back into a stage 2 uptrend, right? And again, same thing. Next pullback, viable, prices above the moving averages. So just by looking at which stage you're in, the exact price where you buy the stock doesn't matter, right? Big traders, big institutionals, they're not caring about cents and dollars. They don't care about, I buy the stock at exactly at 44.10, right? That's not how we do it. It's a zone. It's a price range. So as long as we're on the right stage, the exact price point doesn't really matter. We could pay up for the stock and still end up being right on the trade. Here's another example of how it might look a little bit differently, right? Stage 4 declining downtrend, right? After stage 3, stock enters a period of sideways consolidation again, finally gets above the sideways consolidation. So now we know this was a stage 4. This is sideways stage 1, breaks out. That's where we would look to buy, and then back into a stage 2. Next pullback, buyable, and then back into a stage 2. So these patterns repeat over and over and over again. The only difference is if you're an investor, you're going to look at the stages on a weekly or monthly time frame, on a monthly or weekly chart. If you're a short-term swing trader holding for a few days to a few weeks, you're going to look at the stages on a daily time frame. If you're somebody who only wants to hold the trade for maybe a day or two, now you're going to look at the 60-minute time frame, right? And if you're a day trader, what are you going to do? 5-minute charts, 15-minute charts. You're going to look for the same exact cycles to be on the right side of the markets. So that, in a nutshell, is the theory part of this presentation. And I'm going to bring up some actual charts, so you can see that this happens on every type of instrument. And again, if there are any questions that you guys have regarding what we've covered thus far, definitely let me know.
Yeah, question for you. So when we talk about being on the right side of the market, and most people think of, okay, what's going on with the S&P 500? Typically, when we look at, say, the S&P 500, how long what is the typical time duration of each one of those stages, accumulation phase, distribution phase, and so forth? And where are we now based on what you see with the charts? What stage would you say we are in right now?
Sure, definitely. Let me bring up my charts, and then we'll go over the chart of the S&P and dive into that. So here. Okay. Okay, so you should be able to see my screen at this point with the charts. So let me go ahead and load up my longer time frame layout. Okay, so now let's take a look at the markets, and it's quite easy to determine which stage we're in. So when we look at it like this, we're clearly in a stage 2 still, despite the recent move down, despite the move up. A lot of people were caught off guard looking at the markets and being surprised of how fast we came back up, because nothing ever changed in the economy, right? We just came back up. But when we step back and we take a look, we are in a macro stage 2 bull trend. All pullbacks are buyable on a higher time frame, right? So the same way here, we're still in a stage 2 uptrend. Now, there is a possibility we're actually entering stage 3, because you notice it's not as smooth as these uptrends, right? It's getting more wide and whippy, as we talked about. In stage 3, things get wide and whippy. This is clearly getting wide and whippy. So if the markets start, let's say, not making new highs and somehow failing in this area, then we know this is a potential stage 3. We don't have that information now. So usually we make our decisions based on saying pullbacks. So for us, we would be buying all of these pullbacks into the 50 MA, right? Because we're still in a macro stage 2. And if you buy every pullback in the macro stage 2, think about it. You can only be wrong once, when the trend finally breaks. But if you bought every little pullback along the way, the gains you've accumulated more than offset, let's say one time you're wrong and the markets pull back, right? So that's why you want to train yourself as a trader to take advantage of these, because when these pullbacks are happening, right, that's where people get scared. Because when they're actually happening, it's easy to look at the chart now and say, oh yeah, we should have bought it there. But when it's actually happening, problem that happens is you look at the news, economy, Russia, Ukraine war, all this thing is going to happen, markets are going to be tough, and people usually let their biases take control rather than step back and just take a look at the chart as it's presented. So, but that's the micro time frame. Now, let me take a look at the daily time frame, because you can see on a different macro perspective, it'd be a little bit different. There we go. So we're seeing here, on a daily time frame after the the COVID decline, when we entered the most bullish period here, markets are going into uptrend. See how this was a nice smooth uptrend, but then right over here, look what's starting to happen, right? You can see that on a daily time frame, where right over here, things are getting now a lot more wide and whippy. Moving averages were, price were above the moving average, but now they're crisscrossing each other here, right? Moving averages finally crisscross, price breaks below it. We break the trend line. Now we know, okay, this market is potentially entering a stage 4. Next rallies are all shortable. And that's pretty much what we did at our firm, was shorting these rallies. And then we're back into a stage 4 downtrend. Then we go back and start drawing our downtrend lines like that. And then now we take a step back. Oops. Now we take a step back here. And then the trend changed right as we broke the trend line. And same thing again, once we broke that trend line here, okay, look at the next pullback. Next pullback, now that same trend line that was resistance became support. Pullbacks are buyable. And then we're back into a now daily chart stage 2. And now we're going to monitor this trend. Now we're in a stage 2. We're going to stay long until the trend breaks. And that's how you would enter these type of scenario trades. Hope that answers your question.
Uh-huh. And so typically, does the duration, the time frame for each one of those stages, is it unique to each and every bull and bear market, and that we don't want to we just let the chart tell us how much time is needed for each stage? I mean, are there any rules of thumb that we could use?
Yeah, so there's no specific time for every instrument. Every stock would have its own time. Some do a stage 1 for months, some do for weeks. So it'll matter on the time frame you're looking at. A good guide is simply to drill down into, let's say, a daily or weekly time frame, and then wait for the moving averages. If the moving averages are flat, right, and price is just hovering up and down between those two lines, then you're in a stage 1 consolidation. There's nothing for us to do there. We just stay out of the market in that period. When we finally see a breakout, which usually will be accompanied by higher volume, and now you'll see a curve in the moving average, price gets above it, that's your indication that something might be changing, and that's what you want to put on your list. Now, you don't want to immediately buy it. You still need a technical pattern to be able to enter the trade, and those technical patterns, as we talked about, are pullbacks into support areas or breakouts. Just keeping it simple. I think with technical analysis, people complicate things so much by all these different indicators, but all indicators are calculated based on the price of the stock. So if you learn how to just read the chart, then you don't require many indicators. I don't even need moving averages, but they offer a good guide. Clearly, they're crisscrossing here. There's not a whole lot going on, right? Until prices get back above it and we see that a pullback to it ends up holding, that's when you know that, okay, things are changing.
Given that the market is currently in bullish mode for S&P 500, should investors or traders be looking for reasons to get long particular stocks that happen to fulfill these type of patterns? Because if we want to be on the right side of the market, we want to be more concentrating on long plays generally.
Yes. So, there'll be difference in perspective of the time frame you are using as a trader. If you're somebody who's a long-term investor, you have nothing to worry about. Market's still in an uptrend. Hold on to your stocks. Nothing for you to do. Now, if you're a short-term trader, then you're going to be in and out all the time, right? So we're going to take advantage of pullbacks. And then when things get ahead of itself, right? So moving averages tend to act as a magnet. When price gets too much away from it, they usually do get a pullback. So you want to buy as close as you can to the moving averages. If you just use that one rule, overall, you're going to be, better than most market participants, is not try to be buying here after multiple up days in a row. That's not what you want to buy. You want to buy the pullbacks into the moving averages, and you're going to be right more often than not. So that's what you would want to use as a rule of thumb. So for traders now, determine your time frame. If you're a short-term swing trader, continue to buy these pullbacks until they don't work, until the trend changes and tells us otherwise. As a long-term investor, depends on where you bought it. Like for me personally, I position myself pretty well into the 50 MA because I do that every time we get an opportunity close to the 50 on the monthly. So I position myself really well. So I'm in a position of saying, hey, what if the markets here, let's say, decide to do a lower high, right? In that case, it kind of makes sense for me to take my profits here because now I only have, let's say, this much of upside, but potentially that much of downside. So the risk outweighs the reward. So in that case, I chose to take profits on majority of my positions in these levels. And I have a few stocks that I'm holding, but I'm not really holding majority of the portfolio that I purchased down over here. So this is a scenario where I would basically say it's a trader's market at the moment or a long-term investor's market. In between traders who are looking for follow through, I think it's going to be a very choppy market because right now anything's possible in this area.
Do you have any examples of well-known individual stocks or sectors which are currently either in stage 3 or stage 1?
Sure. So let's take a look at some examples earlier, just from last couple of years, and you will see what I mean by the market stages and how they play out all the time. Look at Roku. The exact same chart that I showed, people in the beginning, which was this one right here. So the exact same chart. This was a stage 1. Roku breaks out, enter a stage 2. Greed takes control. Wide and whippy movement starts back into a stage 4. So Roku is now into a stage 1, right? The stage 4 downtrend has ended. It's entering a period of sideways consolidation. So now how we want to time the trade, we're going to go down a time frame lower to the weekly time frame. Now we take a look. Moving averages are nicely sloping. Look what's happening now. Now they're getting tighter. They're getting flatter, right? It's curving. And sooner, if Roku can get above, let's say the 70, 80 again, then prices back up. The moving average is going to start to curl again. That's a live example of a trade that I'm watching at the moment. We again, take a look on the weekly time frame. Stage 3, that's where the double tops happen. We spoke about that earlier as well. Stage 3, wide and whippy. Double top, price breaks the moving averages, stage 4 downtrend. So that's one example of a trade. Let's take a look at Zoom Communication. Exact same chart. Stage 1 sideways, breakout into stage 2, wide and whippy into the stage 3, back into a stage 4, now back into a stage 1. So same thing we'll do. We'll go on a weekly time frame. We'll see that this is not done going down yet, perhaps because the moving averages are still, they have a pretty good distance. Until they start crisscrossing, until the price gets back above it, we're not in a stage 2. We're not close to that yet. That's how you know not to prematurely enter these trades, but waiting for prices to get above those moving averages and seeing that curvature happen on to the moving average. So that's Zoom Communication. And then let's take a look at Spotify. Stage 1, breakout into a stage 2. This is stage 1, breakout into stage 2. Gets wide and whippy. That's where we get our head and shoulders patterns we talked about. Breaks head and shoulders, back into a stage 4, right? Then this one here and didn't give us much of a stage one, at least on a monthly time frame. But I'm sure if we go into the daily, we're going to see some level of consolidation before it went back up again. There we go. Stage one accumulation base. Prices finally crisscross above the moving averages. The curvature of the moving average is now sloping up. This is where you could have timed your entry on Spotify, buying this downtrend line break right over there, back into a stage two. So see how these patterns repeat over and over and over again. And people would say, well, what about like Bitcoin? Let's take a look. Look at Bitcoin, right? Stage one. Here we get a sideways breakout off a wedge pattern, enter a stage through, wide and whippy, double tops happen on a stage three, breaks below the moving averages, back into a stage four, right? Now we're entering potentially back into a stage two. Now, if I zoom out and say, but this is just, 2021, what about previously? If we zoom in the chart in, we're going to start to see it happened again in 2017. Sideways base, breakout into stage two, back into a stage four, little consolidation, back into a stage two. So these patterns just happen over and over and over again.
So where is stage one on Bitcoin? So stage one, was that during December, January timeframe, or November, December 2022?
Correct. So we're going to have to lower our time frame to find the right entry. So monthly is where we kind of get our bias. Okay, which macro, where are we? Which stage we're in? Now, once we figured out which stage we're in, then you're going to drill down to see those type of consolidations and things change. So you can clearly see on Bitcoin, now that I go on a daily chart, stage four downtrend, now we just start going sideways, right? Sideways. Now here, finally, when let's say you get a little micro trend there, we break that. Now prices, all the moving averages are, nicely hugging the prices above moving averages. That would be an early indication that, okay, we're entering stage two. Now, if you miss that entry, because these ones are a little bit harder to time for a lot of newer traders. If you miss it, perfectly fine to buy the next pullback, as we talked about. Anytime you've confirmed a trend change, the next first pullback is always viable. So that when it pulls back here, that would be a great sign to buy Bitcoin back into a stage two, right? And then we talked about how in stage two we get breakouts. If you're in a stage two, what is this? That's our stage two breakout, right? That could have been bought just a few days ago. So those are some of the examples that you can take a look at. And there's tons of examples I can show you of the exact same movement on a variety of different stocks, instruments, Cannabis ETF. You want to take a look at that. So Cannabis is one thing to watch for 2025 that right now it's in the end of the stage four, right? We had if you go to the daily, we'll see it more clearly here. Stage one, entering stage two, all pullbacks into the moving average is viable, wide and whippy. You get a head and shoulders pattern, right? Breaks below the moving averages here, enter a stage four, and now it's just in a perpetuity. It's just been going down. But notice how recently it stopped going down. It's starting to go sideways now on the MSOS ETF, right? For the marijuana sector. So now if prices break out above, let's say, let's just say 650, right? And then the moving averages are curling up instead of going flat, that would be a sign that, okay, this might be at the end of a potential stage four downtrend.
So in the case of, say, Roku and Zoom, which both had very strong downtrends, which continued even though we've had a significant rally in the regular stock markets, and the same thing with the marijuana sector. What would you say to someone who would argue that, we see these are examples of a fundamentally broken stock or sector, which could continue much, much lower. And the fact that it didn't rally with the S&P 500 shows that it originally was a massive bubble, and it could be one of those sectors or stocks which never recover. And should we be applying those four stages to those individual stocks like we can and should with the regular stock market?
Great question. And I think a lot of people think the same way. Now, first of all, I absolutely agree. I think a lot of these stocks that I talked about were bubble stocks. They profited a lot on the 2020, right? Sitting at home, people can go out. I mean, the best thing that could ever happen to a company like Zoom or Roku is people get stuck at home, right? And they get the users. So I totally agree. And I think majority of these stocks are never going to come back to their all-time highs. And I say that because I know we should never use as a term in trading or investing, but I don't think Zoom, Roku, these stocks will ever going to come back. But can we take trades along the way? That's the mindset of a trader versus an investor. Investors looking at the company, how good is the company? Is it going to make a comeback? I want to hold on for long term. As a trader, let's say I buy Roku, which I probably will if it breaks out above this resistance area, because that's a stage 1 breakout. We're above the moving averages. So when that happens, I'm not going to hold on forever. If I buy it at 75, I get a good move, let's say to the next area around 140, I will be out, right? So I'm taking profits along the way. So swing trading is basically trading the swings. So if this pullback, which I think would have been viable, then I'm going to be selling it on the next rally. Then I'm going to look to buy it again, and I'm going to look to sell it again. So as a trader, we're timing our trades by getting in and out. So I don't really look at or care about fundamentals as much because, it's okay to have biases. We all have biases about different companies and stocks, but then we got to take a step back and say, okay, what is the chart telling me? And I just try to focus on what the chart's telling me. That's how I can stay objective, because my own thoughts about a company or stock, they're kind of subjective. I don't have any data for my feelings, whereas I have data for my charts and patterns to see, okay, how they've performed over the last 50 years.
I see. So in this particular example for Roku, would you be potentially looking at buying it if it crossed above those two, looks like they're moving average blue lines or the red lines?
Yeah. Yes. So that is an early entry. So I would, the confirmed entry would be above here. And the reason for that is if you go on a weekly time frame, let me take a look. There you go. So we're going to take a weekly time frame. That'll be above this red candle, right? So I would want to buy above that because that's a pretty good sign that, hey, sellers were trying to make it back down, buyers took control. So then what we get is a higher low, right? We came up, we went up again. Now we get a higher low. Now we're in a new trend, right? So I always tell people a good way to coach traders is, let's say a company is called Downtrend Incorporated. Okay. This company is called Downtrend Incorporated. What's his job? What product does this company make? Well, this company makes only one product. It makes lower highs and lower lows. Makes lower highs and lower lows, right? That's what the product makes. So now clearly it's making that product. The contract is with Downtrend Incorporated, but now suddenly something changed here. We're not making lower highs and lower lows. So now we got to wait for the contract to be transferred to a different company known as Uptrend Incorporated. Its product is to make higher highs and higher lows. So when it starts making its product, then we're going to jump into the trend. So for me, we are clearly in a sideways pattern here. Once we break that, that's where the confirmed trigger happens into a stage 2. And Roku could absolutely see a pretty good move despite the fundamentals of that. Now, an advanced trader will say, you know what, I want to sneak in it a bit early. I see that this pullback happened into the 200 period moving average. I might just pick it up on this pullback. Or if it gets above the moving averages, that'll be an early entry. So, but that's kind of what we're looking for is we got that high, we got that higher low, but we need to see if the contract's transferred to Uptrend Incorporated or not, for which it'll have to break above this high.
We have a question from Tessa. You mentioned buyable pullbacks and how that's where traders can struggle, psychologically struggle. What is an actionable thing that traders can do or practice doing to help overcome that?
Yeah, I think being objectivity, and it's, sad to say, that's something, it's like a muscle, right? Like people have to train themselves to be objective all the time, because it's very easy for anybody like me to come in and say, hey, look at the chart, you could have bought it here. But then a new trader looks at it, but at the time it's falling into that area, your emotions take control. And then you start looking at stock tweets or Twitter or other places that people are talking bad about the company. Fundamentals are not that great. And you start doubting yourself, if I should do it. Roku's a horrible company. Is it ever going to come back? Should I buy it? And to eliminate that self-doubt, there's no other way but to progressive desensitization. You just have to keep, getting yourself conditioned to pulling the trigger. And that's a hard thing for newer traders, pulling the trigger. They don't trust their plan. The reason I trust my plan is because I've done it over and over again. And I've seen the results, and I've back tested these strategies using models and take a look how they would have performed over the last 5, 10, 15, 20 years, and have a lot of reference points under my belt of trades that I've taken that have worked out. So that gives me the confidence to do that. So for newer traders, just take a step back, always disassociate yourself with the trade, because it's very easy for us to get emotionally invested in a trade. Take a step back, and an exercise that I always use is, hey, if my nephew, let's say his young nephew, he wants to learn trading and he's taking this trade, what would I tell him? It's very easy when we're guiding other people, advising, to be objective. But when it's us, we're emotionally involved in the trade. So I'd say, okay, if my nephew wanted to buy this stock, he emailed me, hey, Anmol, should I buy it or not? What would I tell him? That would usually get you to make the right decisions. So,
so is stage 3 the inverse, perfect inverse of stage 1, or are there qualitative differences between stage 3 and stage 1 other than just being a reverse of each other?
no, great question. So the differences are stage 1 bases sideways are going to be narrow. They're going to be narrow. They're not moving, with big swings. Whereas on a stage 3, the difference would be that it's going to be wide and whippy, right? Like big moves, double tops, head and shoulders. That's where all those patterns are going to set up. And a good way to know is taking a look at what the prior move is. If the wide and whippy is coming after a big uptrend, well, it's pretty safe to say that's going to be a stage 3 because it's coming after a stage 2, right? But if it's coming after the stock has been falling and it starts to do the sideways, well, then we know it's coming after a stage 4. So this is a more likely a stage 1 base. So that's a good way to know which stage we're in. And another thing we talked about is putting the 21 moving average or the 50-period moving average on your daily, weekly timeframes. And a break below those moving averages usually signal the trend in that direction.
Are there any sectors that you've seen that you would say is currently in a stage 1?
I think Cathie Wood ARK ETF is entering a stage 2. Now, again, I don't like any of her stocks she holds, but look at the monthly chart of Cathie Wood. Let's take a look again. Exact same stuff. Stage 1, you get a little breakout, breaks out, enters stage 2, starts to get wide and whippy. Stage 3, breaks below moving averages. Stage 4, downtrend. Now look what's happening again. Exactly where it consolidated last time, right? Exactly where it's consolidating again. So now Cathie Wood ETF is potentially entering a stage 2 or a stage 1. It could be a massive stage 1, right? Because the moving averages haven't caught up. But the reason why I'm indicating it could be a stage 2 potential is here the contract sort of got transferred a little bit, right? We can see that this was a higher low than this one. So if it goes up here, then that's a higher high. So that could be an early signal that this might be entering a stage 2. Now, to be able to do that, we could take a look and dive in to a smaller time frame, and we'll see that accumulation sideways base, volumes picking up at the lows, right? You break through a little micro downtrend line right there. Now you're above all the moving averages, 9, 21, 50, and you can see the pullback was buyable just a few days ago. It went up again. So that's telling me that, okay, Cathie Wood ETF, one to watch at this point. And if it gets above this $45, then as a trader, there's pretty clear room up until 52. That's a $7, 7 point per share trade. And then we'll reevaluate and look to buy the next pullback and do the cycle again. So Cathie Wood ARK is definitely one to watch. A lot of her stocks that she holds, actually, like Zoom, Roku, they're all into that area. Coinbase was a good example of that too. If we go into micro time frames, stage 1, stage 2, back into downtrend. This is in a stage 1 right now. Let me go ahead and delete these lines, clean up the chart a little bit. So Coinbase is clearly in a stage 1 now because it's coming after a stage 4. So if it breaks above these areas of 75, 76, potentially Coinbase will be entering another stage 2 uptrend. So those are some of the things to keep an eye out on.
Question, do you use stop losses?
Yes. So when it comes to trading, that's one of my biggest rules. I determine the stop loss before I determine anything else, right? You need to know when you're going to get out when you're wrong, because it's very easy for us to get caught up and say, oh, this trade's going to work. We get overconfident. We want it to work, or you have your market biases. There's no way it can work, but you need to know when you're going to get out. So the 3 things people need to know before taking any trade is, where am I going to get in? Where am I going to get out if I'm right on the trade? What's my target? And where am I going to get out if I'm wrong on the trade? What's my stop loss? Because if you don't know what your stop loss is, then how do you know how much are you risking on the trade? You have no concept of risk. And that is a surefire way to not last long in the business, right? You're going to get a few winning streaks along the way, but that one loss will wipe away. And it only takes one. Trust me on that. It only takes one loss if you're undisciplined and you don't have a stop loss. I've seen that with so many traders that I've crossed paths with over the years that were great traders. But 1 or 2 times that they didn't put a stop loss in, they caught up in their bias, and that ruins their trading account. So you need to know when you're going to get out. because that is the only way you're going to figure out what you're actually risking. Like, I know pretty much exactly what I'm going to lose on a trade before I take it. How? Well, if I buy a stock at $100, let's say, and let's say my stop loss is $99, for example. And this is just an example. So I'm risking clearly $1 per share. So now if I don't want to lose, I'm like, you know what? I'm okay risking $1,000 on this trade. I don't want to lose more than that. Well, I know if I'm risking $1, well, I can buy 1,000 shares. So if I buy 1,000 shares and it stops out, I will lose exactly what I wanted to lose, which is $1,000, right? That's how you determine how many shares you're going to buy or sell. So it's really important to know what your risk is.
Uh-huh. And how often do you run into the situation where your stops get triggered on a trade, and then you look at it and you say, "Oh, well, if I just adjust my stop a little bit more, and I really am still bullish on this." And how long of a time period do you give yourself before you re-enter the trade? And are there tricks to help help protect us so that we don't feel the need to kind of revenge trade in a way?
Yeah, so that's a great question, by the way. And you know, we're talking about re-entries with stops. So the stop loss is like an insurance policy, right? It'll ensure that the worst case scenario will never happen. Sure, you're gonna get trades along the way that, you know, take out your stop loss by a little bit, then they end up coming right back again. But here's the good part: if you get stopped out and it comes back, you can always get back in, right? But what you eliminate is something that never comes back. I mean, remember Truth Social had a stock, Duoc or whatever that was called, you know, Trump's company. Like, imagine not using stop losses on this, right? Stock went from $170 to like 12. So stop losses are there for you because in the markets, that's the only thing we can control. We cannot control what the stock's going to do. We cannot control what the market's going to do. We cannot even control like how much we're going to make on the trade. The only thing in trading we actually have control over is how much we're going to lose. So if you don't even if you give that control away, then you have no control. So you need to know what your risk tolerance is. And if you want to get back in, simply ask yourself the question: the reason that I'm getting into the trade, are those reasons still valid? And if this is just a shakeout and the price is back up again, the pattern is still valid, then allow yourself to get back in. Because again, it's okay to take a bunch of paper cut losses. It's okay to take small losses. What you don't want is that disaster loss that you're holding on to, and then the trade becomes an investment, you know? So you don't want that.
Do you hold any positions for days, weeks, months? Are you an investor in any particular stock or commodity?
Yes. So, you know, from a shorter standpoint, I have different trades for different accounts. So in my shorter term account, I have this stock that I bought 3 days ago. It's called SM Energy. SM Energy. And the reason I bought it, well, same thing. You know, it's in a wide and whippy, stage 3, stage 4, starts to go sideways again. Price is getting back above the moving averages again, right? Moving averages are curling. So I bought this pullback here around like $29 just, you know, 3-4 days ago. And so far the trade's looking great. And if this is indeed a transition, which it could be, because, you know, this was a downtrend was broken here, then this stock would have potential to go up into 33, 34, which would be where I would look to get out as my target. But then I have a stop loss. I never enter a trade without a stop loss. My stop loss is pretty much under that green candle, because the reason I got into the trade, let's say this downtrend line breakout, if it comes back into it and takes out this blue line, well, it's no longer the reason I got into the trade is no longer valid. So I have to get out of the trade. But if the trend maintains itself the way it's looking, it might, then this would be potentially an uptrend. Then all pullbacks are going to be viable until the $34 area. So that's an example of a live trade that I'm currently in. But then there's investment wise, my Tesla is kind of the only one that I'm really holding at the moment. As I said, I had a lot of stocks that I hold long term. This is my long term portfolio right here. I don't know if I can see that, but these are all the stocks that I have in my long term account, which is for investment only, right? Which is, I'm not trading them. I'm not in and out of them a lot. These are just, I take percentage of my trading profits, usually 10 to 15% of my income from trading, I take and automatically just invest it into these stocks, which are the basic ones, you know, Microsoft, Google, Amazon, Tesla, Verizon, Intel, Nvidia, AMD. I got a little crypto, Algorand, BA, Boeing, FedEx, Uber, Meta, DoorDash, Shake Shack, Disney, Zoom, Netflix. Now, all these stocks I bought pretty well because I established positions right around the stage 4, end of stage 4. This is Tesla, right? Tesla came all the way, same thing, stage 1, sideways, breaks out, and stage 2, every little pullback to moving average is viable. wide and whippy, right? The trend breaks, entering stage 4, downtrend. But again, 50 MA on the monthly chart, as I said, is usually a pretty good spot to always be buying. I bought it here on Tesla, and the trade obviously is looking phenomenal at this moment and breaking through a weekly downtrend as well. So any pullbacks on Tesla at this point are buyable, even if you miss this early decline, because the contract has already been transferred, right? Higher low, higher high. So now pullbacks are viable, because this is what it's going to end. Eventually, I think it's heading to at least 310, and we'll see what happens there. So that is an example.
And to what degree, for your long-term investments, to what degree do the stages in the broader market, say the S&P 500, influence you to lighten up on your long-term investments, even if these long-term investments don't yet show a definable stage that they're in? Does the overall market influence you to increase or decrease your positions in your longer-term holdings?
Yes. So if the markets, for example, using my own example of trades, so obviously when we're pulling back, it's a good spot to buy. But then when I look at the markets and saying, okay, we look like the angle of the uptrend that happened from, let's say, 2009, suddenly changing, things seem to be getting more wide and whippier. That tells me that, okay, we might be potentially entering a macro stage 3. So yes, if you bought it correctly, then you should absolutely lighten up, right? Because a lot of the stocks have rallied 40, 50, 60% off those lows, right? Even basic stuff like, I'll show you some of the ones that I bought. Google, same thing. Look at that 50-period moving average on the monthly time frame was buyable, right? So same exact pattern, stage 2, stage 4. So if I bought it here, Google went up from 88 to 120. Now you got to ask yourself the question, typically, let's say the stock market averages 10, 12% a year. Your position on Google is already up from 80 to 120. Now, and other stocks too, for Amazon or even Microsoft, let's say, same thing, pull back into the 50 MA. Let's say you bought at 216 and now it's at 340. Now, what are the odds that these things keep going until the end of the year? That's when, as a trader, you got to make an educated guess and say, okay, looks like, my Microsoft position, I did really well on it. It might do the pullback again, just like it did over here. Seems like a good area to start lightening up my shares. And that's pretty much what I did. So I only hold Tesla at the moment. Majority of my long-term stuff I've sold, and I'm going to look to rebuy on a pullback. And NVIDIA is the same exact thing. Stage 1, stage 2, stage 3, stage 4. You could have bought that monthly 50. Stock went from 117 to 420. Now, if you're holding it, I don't know what to say. If you're buying it here, I don't know what to say. I bought it here. I actually sold it quite early. I sold it before, I think a day before it gapped up. Yeah, I ended up selling it right here at like 316. So I missed out on that. But as a trader, if you buy it correctly, it's fine. You got the meat of the move, and that's what you want to try to time. You're never going to get the perfect entry or the perfect exit. But I can tell you, if you buy things correctly, as we talked about, being on the right side of the market, you're going to be right more so than wrong. And wherever you sell, it's basically just, difference between you want the meat, you want the bones, what you're going for. So you're never going to time the top or the bottom. Just try to be on the right side.
Great. Well said. Anmol, thank you very much for coming on Chat with Traders Community. How can we reach you?
Yeah, definitely. I think the best place to reach me would be Twitter or Instagram. My username is the same on both of them. It's Delta90, DELTA9NETY, spelled out. Don't ask me why. I used to play a lot of video games and trading, and then the account got verified, and I didn't want to change the username, so I just kept it the same. So that's the username, Delta90. And if you're interested in learning more and going deeper with trading, you could always go to livetraders.com or livetradersguide.com, where you'll be able to download our free guide and a free video course.
Great. Did that username Delta90, was that influenced by your experience with options?
Correct. I used to use a stock replacement strategy by using Delta90 options. I didn't have the money back in the day to actually buy, the full stocks. So I would use Delta90 options as a cheaper way to get into those stocks.
Oh, great. Great. Well, thank you, Anmol, for coming on the show.
Thank you for having me. It was great chatting with you.